Good evening, students. I'm C. Ankit Sharma, your income tax faculty for the session. Today is our sixth and last session of capital gain topic. In the previous 5 sessions, we have gone through with the provision of capital gain from introduction till the exemption part we were discussing. In the last session, we have covered section 1037, that was the income-based exemption in case of capital gain in respect of compulsory acquisition of your agricultural land. Then we have gone through with the provision of section 54. Those were mutually exclusive exemption. Mutually exclusive means there are certain exemptions, those in these cases, if you specifically transfer one asset, then you have to purchase accordingly the other asset. So suppose if you are purchasing a residential house against a transfer of a residential house, then only section 54 can be applicable for the purpose of exemption. So it does not mean that in a capital gain, we can only claim one exemption. Mutually exclusive does not mean that suppose Mr. A is having a capital gain of residential house of 100 lakh. So mutually exclusive does not mean that only Mr. A can claim one exemption. Mutually exclusive mean that you can claim exemption of various investment scheme, but a particular exemption will be applicable only if they satisfy the certain condition. For example, if you transfer a agricultural land, then on purchasing of an agricultural land, only section 54B is there for exemption. So there are specific nature-wise mutual exclusivity. Okay. So we were going to discuss today section 54F example. The section we have covered in the last session was theoretical provision of all exemption. Today we will cover numerical example of section 54F. Then the taxability of capital gain. So we have multiple different kinds of rate in cases of different kinds of capital gain. We are having short-term capital gain under section 111A. Then we have other short-term capital gains. We are having long-term capital gain under section 112A. Then other long-term capital gain before 23rd of July, what are the rate structure? On or after 23rd of July, what are the rate structure? We will go one by one. Okay, I have also uploaded the notes and the chart also. That is a very special chart what I have uploaded for tax rate purpose. So it took me a lot of time to prepare that chart. I manually prepared it and then I have converted into the Word format and I have uploaded it for you. So that would be really easy to understand or to make you understand that which kind of capital gain is going to be taxable at which rate. We are also going to discuss some test your knowledge question from your study material, example also today, and the previous question of buyback. We have left two previous questions of buyback, so I would like to discuss that also. But before that, I would love to see who is going to summarize the provision of our last session. In the last session topic, I would like to summarize you only section 1037 exemption and those 5 exemption we have gone through: 54, 54B, 54D, 54EC, and 54F. In respect of these 5 exemptions, I would like to know any one of you who is going to summarize the basic 4 points only. What we need to transfer and what in which scheme we have to invest or what property we need to purchase. The second is assessee. In case of section 54, who should be the assessee to claim the exemption? Amount of exemption in different sections and the period of investment. The other points that the asset should not be transferred. If it is transferred within a specified time, what are the consequences? And point number 5 and 6, please do not summarize those points because they are general point. In a single exemption, if you are going through those points, they are going to be repetitive, almost same. So let me see who is raising hand. Okay, Priyanshi wants to summarize the provision. So can we unmute Priyanshi, Almas, Tanu, Harshada? They all wants to summarize the provision. So Priyanshi, you, I guess you should summarize section 1037 and exemption number 54. Exemption 54, section 54 exemption. Almas, you need to explain or summarize the section 54B and 54D. Tanu, you will summarize section 54 EC, and Harshada, you will summarize section 54F. Okay, it's clear. So first of all, Priyanshi will explain us the summarized provision of section 1037 and section 54. So can we unmute Priyanshi? Mr. Manish, can we unmute Priyanshi?
Good evening, sir.
Yes, good evening, Priyanshi. Go ahead.
Yes, sir. So first of all, under section 1037, the exemptions of capital gain, the first is on compulsory acquisition of agricultural land situated within specified urban limits. Fine. So its conditions are it should be a specified urban limit. Second is should be individual and HUF. Third, transfer of agricultural land. Fourth, compulsory acquisition should be there. Fifth, received on or after 1st April 2004. Sixth, it has been used for agricultural purpose only. Seventh, during 2 years preceding 2 years immediately preceding date of transfer. And last is by individual, his parent or HUF and his parent. Fine. And under section 54, it is of capital gain on sale of residential house and purchase of residential house or construct of residential house only. Eligible SSCs are individual and HUF. Conditions should be fulfilled. Transfer of residential house, long term, and income from such residential house should be charged under income from house property. Where capital gain is less than 2 crores, then one residential house in India should be purchased within before 1 year of transfer or after 2 years of transfer, and construction within 3 years of transfer after date of transfer. Where if capital gain is more than 2, if capital gain is less than 2 crores, then the purchase of two residential house within 1 year before, and these conditions are same for construction 3 years and 1 year before date of transfer, 2 years after date of transfer for purchase. And then we have seen that in two in a year, once in a lifetime, and next any one of them means transfer of two purchases or two construction. This should be always in once in a lifetime of a year. I mean once in a lifetime. Then we have seen some conditions that such purchases, construction exempted, cannot transfer within 3 years. And to claim exemptions, there are two options up to the date of return on investment, which is 31st of July 2025 and 31st of October 2025. Option first is have to actually purchase or construct complete new residential house. If it is done, then claim exemption. And option second is that we don't know that we have to purchase or construct after in future circumstances we don't know, then we will deposit the estimated.
Correct, Priyanshi, but I want to correct you that when you said section 54 is about residential house sale, it should not be sale, it should be transfer. Because sale is a single term of transfer. So it could be exchange, it could be sale, it could be relinquishment. In all these cases, you would be able to claim the exemption. Wonderful explanation, Priyanshi. Well done. So now, Almas, please you continue. You will summarize as the provision of section 54B and 54D.
Good evening, sir. Section 54B, agricultural land is transferred and a new agricultural land is purchased. The assessees are individual and HUF. It can be long-term capital asset or short-term capital asset, and it must be used in the immediately preceding 2 years before the date of transfer by individual parents or HUF, and new agricultural land must be purchased 2 years from the date of transfer, and it can be purchased in rural or urban areas, and newly acquired agricultural land should not be transferred within 3 years. If it is transferred, the cost of acquisition will be reduced by the exemption claimed.
Can you tell me, Almas, in section 54B, the agricultural land we are transferring, whether it should be rural area or urban area agricultural land, the land we are transferring?
It should be situated in urban area.
Very good. Okay, next now, section 54D. Continue, please.
It is compulsory acquisition of land or building forming part of industrial industry, it is factory, and transferred, and new land on building is purchased or constructed. This is available to all SSEs. It can be long term or short term. Then the factory must be used 2 years preceding the date of transfer, and the purchase or the construction should take place within 3 years from the date of transfer, and it should not be transferred within 3 years.
Well done, well done. The other points are same as section 54. Priyanshi, I would like also to correct you that you did not explain the 10 crore limit. The maximum limit under section 54 was 10 crore rupee. So I guess you skipped that point also. That is also very important. Okay. Next is Ms. Tanu. You will explain us section 54 EC provision. Tanu, please continue.
Sir, in section 54 EC, eligible SSC
थोड़ा
should be
loud,
any
आवाज नहीं आ रही आपकी. थोड़ा loud बोलो.
सर अभी आ रही है?
हाँ अभी ठीक है. Okay.
Sir, in 54 EC, eligible SSC should be any SSC. इसमें मतलब कोई भी SSC एलिजिबल हो सकता है ये डिडक्शन एग्जेम्पशन चेंज करने के लिए, और कंडीशन इसमें है कि ये एसेट जो ट्रांसफर हो रहा है वो लॉन्ग टर्म कैपिटल एसेट्स होना चाहिए. ये लैंड भी हो सकता है, बिल्डिंग भी हो सकता है, और दोनों ही हो सकता है. और ये जो एसेट ट्रांसफर हो रहा है ये डेप्रिसिएबल एसेट्स होना चाहिए. एंड थर्ड पॉइंट है कैपिटल गेन जो अराइज हुआ है ट्रांसफर से, उसको हमें लॉन्ग टर्म हम इसको किसमें इन्वेस्ट कर सकते हैं? लॉन्ग टर्म स्पेसिफाइड एसेट्स में हमें विद इन 6 मंथ के अंदर ही हमें इसे इन्वेस्ट कर देना है. इसी तभी हमें एग्जेम्पशन मिलेगा, नहीं तो फिर हमें एग्जेम्पशन नहीं मिलेगा. और ये लॉन्ग टर्म एसेट्स कौन कौन से हो सकते हैं? जैसे कि रिडीमेबल स्पेसिफाइड बॉन्ड्स हो सकते हैं, और NHAI के बॉन्ड्स हो सकते हैं, और RECL के बॉन्ड्स हो सकते हैं, एक्सेट्रा. और ये डिडक्शन मतलब जब अगर हम अवेल कर लेते हैं तो हमें ये 5 ईयर तक इसे मतलब कि ट्रांसफर नहीं कर सकते या फिर कन्वर्ट नहीं कर सकते हैं किसी और कैपिटल एसेट्स में.
Correct. Your voice was very low, but still I understand that you explained the correct provision. Well done, Tanu. Now, Harshada, you please continue section 54F provision.
Okay. Good evening, sir. Section 54F basically tells us about the capital gain in case of an investment in the residential house, wherein we are investing, means we have any investments in other than residential house, we can convert that into and purchase a residential house in the transfer of any capital asset, and we can buy a residential house, and the period is a long-term, these are the long-term capital asset. And the limit for the capital gain is 2 crores and maximum up to 10 crores. And it cannot be the capital once we transferred, we cannot be once we claim the exemptions, we cannot transfer the asset within 2 or 3 years. And the time limit to purchase is 1 year before the transfer, 2 years after the transfer in case of a purchase, and in case of a construction, it's after 3 years we cannot transfer those assets, and we can make a deposit in a capital gain account scheme. And to find out the capital amount of exemptions, there is a formula like original capital gain upon net sales consideration multiplied by new investment in the residential house. Likewise, we can find it out for amount utilized, misutilized amount. And the basic difference between the 54 EC 54F and between the 54B and D is nature of capital gain. Change in the nature of the capital gain, because it's a short term and long term capital gain.
Okay, well done, all of you. Thank you so much. So now we will continue forward. Mr. Jayendra is asking section 54 EC notes bond issued 1/4/2006 towards in module issued on or after 1/4/2018. Yes, Mr. Jain. On or after 1/4/2018, the redeemable time period has been extended to 5 years. So for the purpose of our examination, the 5-year limit would be applicable. Before that, it was 3 years. So you are absolutely correct. Okay. Mr. Jendra also asking special provision about NR is only for unlisted shares, for unlisted share 24 months and for unlisted debenture before 23rd of July 36 months. After yes, section 50AA we have also covered. And this provision of time section 50AA is for both resident or non-resident. ADR and share difference I have explained in section 47. For the time being, ADR is American Depository Receipt. In that case, we do not issue share in India. We issue share in India to a custodian, not to the public. And the custodian hold those shares, and against those shares, we issue depository receipt. If it in America, it would be called American Depository Receipt. If it is other than America, then we called it Global Depository Receipt. So all features of shares and ADR, GDRs are same except the voting right. Okay. So moving on to section 54F. We have covered section 54F in the last class, but I would like to discuss an example so you will understand how it is different from other section. The solution criteria, the implication of the provision due to this, you can see this proportionate exemption. Things would have changed in case of section 54F. So let me explain you with a small example of section 54F. So you will get to know how to solve this kind of question in the examination. Okay. So suppose Mr. A has transferred some asset and they all are long-term capital asset. Transfer take place before 23rd of July 2024. Suppose he transfer gold and shares and bonds. Suppose the sales consideration was, in case of gold was 100 lakh, in case of shares it was 40 lakh, in case of bond, suppose it's 10 lakh. The index cost of acquisition, suppose in this case it's 60 lakh, in this case it's 10 lakh, and in this case it's 8 lakh. So in case of bonds, we do not do the indexation. So suppose this is without indexation. So now we are having our resultant capital gain as under the long-term capital gain is 40 lakh. In this case, it's 30 lakh. In this case, it's 2 lakhs. So if I'll ask you a very simple question, that if suppose Mr. A wants to purchase a new residential house, out of the proceed, how much maximum amount he can invest? Maximum amount he can invest to purchase a new residential house out of the proceed of these 3 assets. The maximum amount could be this value, 1 lakh, 150 lakh. So he can purchase a new residential house for rupees 150 lakh maximum, not with the gain, with the sale proceed. Suppose the sale proceed, sale consideration is 150 lakh. And if the net sale consideration, suppose there are some expenditure on transfer also, suppose 5 lakh rupees, then our net sale consideration would have been 145. So that is 145 would be the maximum amount someone can invest. So what is the maximum amount somebody can invest is technically net sale consideration. In our example, sales consideration and net sale consideration is same because there is no expense on transfer. So he could purchase the residential house worth rupees 150 lakh maximum. Now suppose he purchased a new residential house for 145 lakh. Not full 150 lakh he utilized 145 lakh new residential house. Now if you'll see, in this case he transferred a long-term capital gain is there, other than a residential house. So he used the money of gold to purchase this property. So gold and this asset is eligible for section 54F exemption because there is a transfer of another property other than the residential house, and out of the proceed of that gold, he purchased a new residential house. So section 54F condition has been fulfilled. So the consideration of gold and the capital gain is eligible to claim section 54F exemption. So same in case of shares. Shares is other than a residential house long-term capital gain, and the proceed has been utilized to purchase a new residential house property. So technically, shares could also be eligible to claim section 54F exemption, and same in case of bond. So in case of section 54F, this is a special circumstances arises when there could be multiple assets. Those are eligible for section 54F exemption. And we do not have any problem. We can give this exemption of 54F from gold, shares and bond, all the asset, if their proportionate exemption formula was not exist. So if there was no proportionate exemption formula was there, so I could reduce exemption of 40 lakh from this, 30 lakh from this, and balance from this. But the problem is something else. The problem is, due to that specific provision of section 54F, the special formula, the proportionate exemption, we have to find out the ranking out of these three assets. We have to see in all the questions in which there are more than one asset is eligible for section 54F. In any other case, if it is applicable, does not matter because you can claim full exemption. So your gain would be reduced 100%. Does not matter if you will provide gold exemption or shares or bonds in any order. But in case of section 54F, because there is proportionate exemption, so we have to find out the ranking of these exemption which we need to provide accordingly. And for the purpose of ranking, again, we are having the same formula. The formula was original capital gain. The formula we are utilizing for exemption for the taxability of misutilized amount and unutilized. We are going to apply the same formula to find out the ranks. Original capital gain upon net sale consideration. Now we need to just multiply it with 100. So you will get the percentage of this exemption purpose. So if we apply this formula, original capital gain upon net sale consideration into 100, then gold is having 40%. What is the meaning of 40%? I will explain. Next, 30 divided by 40 into 100, we are having 75% in case of shares, and in case of bonds, this is 20%. So what does that percentage denote? What does that percentage explain? What does that percentage wants to make you understand? The percentage says if you invest, listen me very carefully, if you invest 1 rupees of consideration, 1 rupees of consideration, if you invest 1 rupees of consideration of gold into residential house, then only 40% of 1 rupees, that means 40 paisa, is going to get exempted. So out of rupees 1 rupees investment, only 40 paisa of gain would be exempted. If you invest 1 rupees of shares consideration for the purpose of exemption, you will get 75 paisa exemption of capital gain, and in case of this you will only get 20 paisa of exemption. So that means this is the most beneficial for the purpose of claiming exemption, and this is having the second and this is having the third rank. So this is the simple formula you can utilize in section 54F multiple times. Whether you want to find out the exemption, you just need to multiply this with the exemption value, the investment value. If you want to find out the unutilized amount taxable, you can multiply that amount with the unutilized amount, and so on for the purpose of misutilized. And even for the purpose of ranking, we are having this one formula. So after find out the ranking, Now we can give the exemption one by one. So total investment was, students, how much it was? 145 lakh new investment, full investment, total. Out of this 150, he invested 145 lakh. Clear? Now we will give the exemption firstly to this. So what was the formula? Original capital gain upon net sale consideration. For the purpose of exemption, the formula was original capital gain upon net sale consideration into investment amount. So can you tell me, original capital gain is 30 lakh, net sale consideration is 40 lakh. What should be the investment amount I should write down over here? Can you tell me what should be the investment amount I should write down over here? Harshada is saying in case of 54F in module, mention a transfer of plot of land is included. Yes, only building has been excluded. And that also residential house has been excluded. Only a land has been transferred. Then against that, if you are going to purchase a residential house, you can claim the exemption. Okay. Okay. Dhanush is saying 145 lakh. Ishan Bisht is saying 145 lakh. Tanu is saying 145. Priyanshi is saying 145. Mohammed Farhan is saying 108. No, Mohammed, I am not asking the exempted amount. You might be giving me the answer of exempted amount. I am just asking how much amount we can invest, how much to claim exemption in case of shares. What should be the maximum investment amount? Soumya is saying 10 crore. No, Soumya, that is exemption amount, not the value. I am asking. Anubhav is exactly saying the correct. And that should be 40 lakh, not 145 lakh. Students, you forgot. From shares consideration, how much maximum he can invest. This is 145, not is from investment of shares value. It is from gold, shares and bonds, all aggregate value. I am finding exemption for shares only now. So how much maximum amount of shares can be utilized to purchase the residential house? That the maximum could be only 40. It could not be 145. That's the problem. Or you can say that's the magic of solving a question practically. Even if you have learned all the provision, but as I've seen that out of 10 or 12 answers, only one answer was correct, and that was 40. So you have learned all the provision, the formula is in front of you. You can see the formula is in front of you, but because we did not practice that kind of question, so this kind of mistake is happened generally. But that's why we are having an example. So you will not do the same mistake when you solve the question. So the maximum could be only that proceed value, which is from that particular asset. So now 40 could be the value. So the exemption would be 30 lakh. So how much was the capital gain? 30. And the exemption under section 54F is also 30. So the capital gain from this asset would be nil. Clear? Now the second rank is for this. So we will go for claiming exemption over here. Now because you have seen how we need to calculate, original capital gain is 40. The net sale consideration is 100. Let me tell you one thing more. Out of this 145, we have utilized 40 lakh for shares already. So now the investment value has been left 105 lakh. Clear? The balance investment is just 105. So out of this gold, how much maximum we can utilize for the purpose of investment? We are having balancing figure of 105 and the net consideration for gold is 100. So how much we can invest out of this gold for the purpose of exemption? Yes, very good. Very good. Now it's 100. So this 100 is complete. The exemption would be, of course, under section 54F is 40. Gain is 40. Exemption is 40. So the taxability would be nil. Clear? So I have utilized 100 also out of this total investment from gold. Now left with 5. Coming on the third rank asset, that is bond. Original capital gain is 2. Net sale consideration is 10. Now can you tell me how much I should multiply? Okay. Anubhav is saying 5. Almas is saying 5. Mohammad Farhan is saying 5. Tanu is also saying 5. Yes, now you got it. Now you are not taking 10 over here. The consideration maximum is 10 left. But we utilized only 5 out of this 10. That's why we did not utilize full consideration. So you can take the net sale consideration or the balance value, whichever is lower. So in the examination, it will happen. Examiner will not allow to invest full 150 lakh, because if full 150 lakh has been invested, so I am going to write it down 10 over here. So there would not be any capital gain. So it would be really easy for all the student to solve it. So examiner will always invest less than the full net sale consideration. So my consideration in this case is 10, but the remaining investment I have just made is 5. So we will multiply it with 5. Clear, students? So now you can see the exemption would be only for 1. So my 1 lakh would be exempted, and the taxable long-term capital gain out of these 3 assets would be only 1 lakh. So that's why section 54F is very important. Do not forget these two things. First, you have to do the ranking. And whenever you are giving exemption as per rank wise, please reduce this value. Please reduce. If you would not reduce it in the paper, might be you are going to write it down full 10 lakh over here. So in that case, your answer would be wrong. So in all questions you can see in 54F, the examiner will not invest the full value. If they'll invest the full value, then in this place, there would not be any capital gain. So remember this step in case of section 54F. For your help, I have also prepared an example. A solved example is also there in the notes of section 54F. So you can try that example. This is section 54F. It's a very interesting example. Same way, I have introduced 4 assets in this case. Example 54F. If there are 2 or more assets eligible for exemption, then ranking will be decided, and asset having highest ranking will be eligible for exemption first, then others. You can see in our example, jewelry, shares, capital index bond, and land was there. We are having net sale consideration 500, 50, 100, and 20. So you can see the maximum investment could be 670 lakh rupees. We are having cost and we are having gain 50 lakh, 20 lakh, 20 lakh, and 15. So the maximum investment could be 670, but the question says he invests only 540 lakh in purchase of residential house. So due to it, we have to do the ranking. So as per ranking, you can see first ranking is this, second is this, third is 20, and fourth is jewelry. Accordingly, we have given exemption. So in this case, full investment value is here. In second case, also you can see full consideration as investment value. In third case also. But in the fourth case, the balancing figure we have to take. The consideration was 500 lakh. But in this case, the balance left was 370. So we have to take 370. I have made calculation to show you over here. 540 total investment. First investment was 20 lakh. Second was 50. Third was 100. So balance was 370. So in the fourth category, we took 370 as balancing figure. So the remaining capital gain would be 13 lakh. So you can do one thing. After the class, you can write it down this question and you can try to solve it yourself. You can do ranking again yourself and you will try. If you will get your gain of 13 lakh rupees, that means you have understood the provision of section 54F very easily. Okay. Mr. Dhanush is saying, sir, why did you give ranking? I have just explained you, Dhanush, that because all assets are eligible for exemption in this case under section 54F, jewelry, shares, etc. And due to that proportionate exemption formula, the proportionate exemption formula, we have to see which asset would be beneficial to claim the exemption first. If you change the order, you can try to solve this question according to your order. You can give rank according to yourself. Then you will see there would be higher capital gain. Fine. And the ranking, you can scroll back the video. We are on YouTube and you can see it again, Dhanush. Okay. So I have asked you to go through with these example and notes in the last session. If you have any query regarding these example or notes, you can ask me. Before that, we are going to discuss section 54H. And it's a very small section, you can see. And it's not an exemption. Section 54, 54B, 54D, 54EC, 54F. They are exemption sections. But section 54H is a clarification section for these exemptions. Now, what this section says, let me explain you with the help of a small example. And after that, I will ask you a very interesting question to all of you. Yes, Ishan, in the example, you also show the ranking. That would be the part of your solution. Okay. So section 54H, why it is there? Now let me give you an example of, take an example of compulsory acquisition. Suppose Mr. A is having a land which has been compulsory acquired by government in 2014. Clear? And the original compensation was decided rupees 80 lakh. So suppose the date of transfer was 11th July. The date of compulsory acquisition was suppose 11th July 2014. So that should be treated as transfer. But we cannot charge the capital gain in this year because he did not receive the compensation. The compensation he received, suppose, on 11th November in 2022. Full compensation he received 80 lakh. And suppose now he wants to invest this compensation for purchase a residential house. He wants to purchase a new residential house for 80 lakh. The capital gain we calculated as per the provision, suppose it comes 60 lakh. So now can you tell me which exemption would be applicable in this case? Which exemption would be applicable in this case? Very interesting question. Can he claim exemption in this case? And if yes, in which section? (54D), Mohammed Farhan is saying. Mohammed Farhan, in section 54D, we transfer or compulsory acquired industrial undertaking. In this example, only land has been compulsory acquired. There is no factory involved. So 54D cannot be applicable. Ishan is saying section 54F. Anyone else? Dhanush is also saying section 54F. Anyone else? Priyanshi also saying 54F. The correct answer is, of course, section 54F. 54F can be applicable because it says any long-term capital gain transfer. And transfer includes sale, exchange, compulsory acquisition, conversion of capital asset into stock in trade, relinquishment. Each and everything has been included in the definition of transfer. So it's a compulsory acquisition which is equivalent to transfer. So that means section 54 exemption can be claimed. But now here is a problem, a very big problem. For claiming section 54F exemption, you should transfer any long-term capital gain other than residential house and need to purchase a residential house. So this condition has been fulfilled. That's why section 54F has been invoked. But there is a problem. Section 54F says either you have to purchased 1 year before from the date of transfer or within 2-year purchase from the date of transfer or within 3-year constraint from the date of transfer. Now, what is the date of transfer in this case? Students, the date of transfer is 2014. And the new house has been purchased in 2022. So this house cannot fall either in this time duration, not in this, not in this. So section 54F says we cannot give you exemption because your time duration has been elapsed. Now assessee says, what is my default? I did not have the money. I would definitely going to invest if I will receive this compensation in 2014. So when I do not have any money, how can I invest? So when I received the money, I invested within a time. But section 54F says that we are stick to the provision. And the law says straightforward that we have to count the time limit from the date of transfer. So whether it's section 54F case, whether it's section 54, suppose a residential house has been compulsory acquired by government in 2016 and compensation received in 2024. He purchased new residential house. So section 54 applicable because there is compulsory acquisition. But again, the compensation received in 2024, he can invest this compensation from the date he received the compensation, not from the date of transfer. At that time, he would not have any money. So he could not claim that exemption by investing that amount in the specific government scheme. So section says we cannot give you the exemption, and assessee was exactly right. He said this is injustice. When I do not have money, how can I invest? So when I get money, I invest in the property. So exemption should be there. So for this problem solution, section 54H is there. And 54H says in these kind of condition, in case of compulsory acquisition, etc., the time limit of 1 year, 2 year, 3 year, or 6 months in all exemption, whether section 54, 54B, 54EC, D, F, in all these cases, the time duration would be counted from the date of receipt of compensation, from the date of receipt of compensation, not from the date of transfer. Understood? So this is section 54F. It's a very welcome clarification because this removed that injustice which the assessee could have been faced due to this section implication. So now section 54H relax the provisions of investment in case of compulsory acquisition of the original asset where the compensation is not received. On the date of transfer, the period available for acquiring a new asset or making investment in CGAS, capital gain and account scheme. Full benefit, whether to purchase or to invest, both benefit would be available from the date of receipt of such compensation and not from the date of transfer in all these sections. Okay. So these example you must have tried, I believe. Now reference to valuation officer, section 55A saying that if assessing officer thinks, if assessing officer may refer the valuation of a capital asset to a valuation officer in following circumstances. So suppose you are saying that I have transferred my asset for 6 lakh rupees. And assessing officer thinks that you are not telling the correct consideration. So he can ask for the valuation of that asset to the valuation officer to ascertaining the fair market value of that capital asset for the purpose of capital gain. For the purpose of valuation, asset transfer to valuation officer for valuation, there are 2 conditions and any of them at least should be fulfilled. The fair market value of the asset on that date. So these are the conditions we are reading. If the assessing officer is of the opinion that the fair market value of the asset. So if your FMV exceed your declared value. So if assessing officer thinks that whatever value you are declaring in respect of any asset, but the fair market value is more than that, then he can refer the valuation to the valuation officer, but at least any of the following conditions should be fulfilled. Exceed the value of the asset as claimed by assessee by more than 15% of the value of the asset as claimed by, or more than by 25,000 of the value of the asset as claimed by the assessor. So if the FMV exceed either 15% of the value declared by the assessee or 25,000 as the value declared by the assessee, then the valuation officer can accept that case sent by the assessing officer. Here are three examples. Suppose value claimed by assessee is 1 lakh. Assessee is saying that the value of the asset is 1 lakh, the consideration. And the FMV in the opinion of assessing officer is 1,20,000. So you can see the FMV is exceeding 15% of the 115% of the value claimed. So because 15% excess condition is fulfilled, so in this scenario, reference can be made to the valuation officer. Suppose the value claimed by assessee 5 lakh and the FMV is 5,40,000. So 15% of 5 lakh is 75,000. It does not exceed, but 25,000 rupees value condition has been fulfilled. So valuation can be made to the valuation officer. In the third example, value claimed is 1 lakh and the FMV in the opinion of AO is 1,12,000. Now you can see it does not exceed 15%. It does not exceed 25,000 in the opinion of assessing officer. So in this case, reference cannot be made to the valuation officer. Theoretical provision, you can go through once. Now the provision, the last provision of capital gain are applicability of tax rate. So what are types of capital gain? How we need to calculate that capital gain, indexation, without indexation, etc. A special cost of acquisition case. And after all that thing, how we need to charge tax on these kinds of capital gain. Now the last topic we are going through. Now in this topic, one is the provision which has been summarized in your study material. One by one, they explain each and everything. In short also, you can see these are in short, and in detail also, the study material explained all these provisions. Now in the detail, you can see the short provision was there, and now the detailed concept provisions are over here regarding long-term taxability, short-term, and all the provisions and the illustration also. I have also prepared a chart for all these provisions, So I've also prepared a chart to make you understand easily all those provisions at a one place. So first of all, I would like to discuss with you the chart provision, and then we will go through with these summarized provision. Because I believe that if you'll go with this provision initially, you would be very confused and maybe very puzzled also that how complicated these provisions are. So to make them very easy for you, to make them summarize at a one place, I have prepared a chart presentation, and after that we will go through with these concepts also. So at that time you will understand, okay, that has been mentioned in chart over there. So these are same things. So with the chart help, you would be really easy to learn those provisions. So let me share you the chart presentation with you. Priyanshi is saying, but in all other section, there is no compulsory acquisition. It is only section 1037. Priyanshi, transfer include compulsory acquisition. So I have explained to you that if the property has been transferred via compulsory acquisition and you purchased a new property, then section 54 exemption would be there. 54B, that says agricultural land transfer. 54D, 54EC, in all those cases when transfer word has been utilized. So it includes all kind of sale, exchange, compulsory acquisition, etc. Okay. Mr. Pawan is saying हिंदी में भी समझा दीजिए ना सर. पवन मैं बिल्कुल हिंदी में समझा देता, but हमारा मीडियम इंग्लिश ही है, इस पर इंस्टीट्यूट गाइडलाइंस. अगर आपको कोई क्वेरी है तो मैं आपको वो हिंदी में समझा दूंगा, दैट इज नॉट अ प्रॉब्लम, बट अगर हम हिंदी में समझाएंगे तो फिर काफी प्रॉब्लम बाकी बच्चों को भी हो जाएगी। ठीक। Harshad is asking, is there any penalty on misutilization of CGAS amount? No, you just, under income tax, you just need to pay the tax because your exemption would not be there. Okay. In the special case, if government wants, AO wants, if your intention was malified, then penalty could be there, but that will depend upon case to case basis. No specific penalty has been mentioned. Okay. So moving on, performa for computation of income under the head capital gain. So let me show you with the help of chart. So one by one, you will see the provision we have already gone through is going to be like a recap. We are going to see all of these things. So first of all, types of capital gain calculation. So either there would be a short-term capital gain or there would be a long-term capital gain. So short-term capital gain does not have any change in the case of calculation. The calculation is same for whole the year. The changes in long-term capital gain, that is before 23rd of July, the separate calculation, and on or after 23rd of July, separate provision. So in case of short-term capital gain, how we are going to calculate that gain? We all know sale consideration, expense on transfer, net sale consideration, cost of indexation, cost of improvement. No indexation required. Then we will have our short-term capital gain. Then we can claim exemption. And you can see out of those 5 exemptions, 54B and 54D is for short-term capital gain and long-term both. All other 3 exemptions is only for long-term capital gain. So all 5 are for long-term capital gain, but only 2 exemptions are there in case of short-term capital gain. So after that, there could be a short-term gain or loss. Simple. One by one, we will go through. Rates of tax would come after this chart. Then in case of long-term capital gain, if it is before 23rd of July, the concept of indexation is there. Same sale consideration expense, the difference is this index cost of acquisition, and even there are certain long-term capital asset on which indexation cannot be done, even before 23rd of July. We have gone through with that provision also, like bonds and debenture, in case of slum sale, etc. Clear? So now the index cost of acquisition, index cost of improvement, then we would have our long-term capital gain. And we can claim 54, 54B, D, EC and F depending if we satisfy all those conditions. Then we would have our long-term capital gain or long-term capital loss. Kevin is asking, sir, 54H also considered that 10 CR limit? Yes, Kevin. 54H was just to extension of time benefit. That for the purpose of calculation of gain, we will not count the time period of 1 year, 2 years, 3 years, 6 months from the date of transfer, but we will take the time from the date of receipt. Just assume in case of receipt date is your transfer date. All other provisions, everything is similar. There is no change. Okay, Kevin? Sure. Okay, so before 23rd of July, in case of long-term capital gain, we do the indexation concept. On or after 23rd of July, this indexation concept has been gone. So the calculation of long-term and short-term is parallel. In case of long-term, which has been arise due to transfer on or after 23rd of July. But there is a special circumstances that in case of land or building or both, that means in case of immovable property, government has made a provision only for individual and HUF. So this is only for immovable property, only for individual HUF, those are resident. That even if they will transfer immovable property on or after 23rd of July 2024, then they will calculate long-term capital gain on immovable property with indexation benefit will be provided in tax calculation. In the GTI, the calculation would be done as per without indexation, but for the purpose of tax calculation, we have to give the indexation benefit if he wants. And if we apply the indexation, the tax rate would be 20%. And without indexation, the tax rate would be 12.5%. So he can get the lower tax out. How practically it's going to be charged, that we will see in our illustration number 7 of test your knowledge question. We will do that in today's class. Do not worry. Students, we are also having a problem class on 5th of June, because after capital gain, there are 2 lectures for income from other source. And then there would be a combined class of problem solving of capital gain and income from other source. So you can go through with all the provisions of capital gain, other source in that duration, and you can ask your queries again in that 5th of June lecture. So Institute is also doing this thing for you, that not during the class you can ask even, but they are also providing you extra lectures for your problem solving. Okay. So this was the provision we have already gone through. Now moving on to the rate structure. Now this is little complex, but this is the easiest way to understand and learn the provision. If you go through with the provision like a paragraph or like theoretical provision, I believe that would be really difficult. After reading with this chart, maybe you will feel this chart is also complicated, because I can't help it. The provisions are very multiple rates are there in case of capital gain. But I assure you, if you'll go once or twice through this chart provision, and then you will start learning the concept from the study material or the notes, you will be able to understand each and everything. I promise you. Okay, today's thought for the day we forgot. So let's discuss the thought for the day of today. It is very simple, very easy. You all know that. We just know everything, but the problem is we do not follow it generally. So what is your future? Your future is created by what you do today, not tomorrow, because tomorrow would be what you are doing today. So whatever you are doing today, that will definitely going to create your future. So please do not waste your time. Please focus. If you focus today, you will get the tomorrow you want, you always dreamed. Okay, that is very simple and very, I guess, important thought for the day. Our provisions. This is not thought for the day. This is the concept of the day. So now calculation of tax for assessment year 25-26 on capital gain. First of all, we have to see the short-term capital gain tax structure. If the short-term capital gain falls under section 111A. So you remember what was section 111A? There was section 112A. And that was for long-term capital asset. So if those does not being a long-term capital asset, but all the other condition of section 112A has been fulfilled. So they would be 111A. And we have also summarized it in a short way. Listed equity shares, units of equity oriented fund, units of business trust if STT paid on sale. So if security transaction tax has been paid at the time of transfer of these 3 assets, and if these are short term, then the rate of tax, if it has been transferred before 23rd July, it would be 15%. If it has been transferred on or after 23rd of July, it would be 20%. Fine. If that is other short-term capital gain, except these, the normal tax rate would be applicable as per slab rate. Up to 2.5 lakh it is exempted, then 5%, then 20% under optional tax regime. 3 lakh basic exemption limit, then 5%, 10% in case of default tax limit. So if there is other short-term capital gain, suppose the short-term capital gain on building, jewelry, land, etc. So if the short-term capital gain does not fall in this category and this category, the all other short-term capital gain is going to be taxed as per normal slab rate person-wise. Depend upon the person-wise. Clear? Suppose the other short-term capital gain related to partnership form. Then partnership firm does not have slab rate. They are having the 30% tax rate. Then the short-term capital gain also going to be taxed as 30%. So depend upon the person. Accordingly, the tax rate is going to be applicable. Clear? So that was 111A asset. The rate is 1520. Then second is a special kind of capital gain, and I believe that kind of capital gain, in my opinion, is not going to be asked in your examination, but that does not mean I'm saying. It does not mean that I'm saying it will not come in examination. Anything can be asked. But it is, please try to learn that this provision could be asked, but in my opinion, it is little complicated, but you have to remember the rate of tax. Transaction in foreign currency. It is not that TTVR, TTSR case, that is separate. So transaction in foreign currency on recognized stock exchange in international financial service center. So even no security transaction has been paid. So do not worry. The detail has been mentioned. When we will go with this concept as per paragraph, then you will find out all these provisions over here also. So whatever is explained in 3 pages, we have just discussed those provisions in 1 column of the chart. So whatever has been prescribed in 2 or 3 pages, you will find out that we have just explained all that concept in this 1 column simply. So if that is transaction in foreign currency on recognized stock exchange in international financial service center. Now what is IFSC etc.? You can Google it because that is not part of our syllabus. Even no STT has been paid. So if the transaction has been done in international financial service center in foreign currency in a recognized stock exchange, and if it is short-term capital gain, because we are discussing short-term capital gain provision, the rate would be 15 and 20. So even if, a very interesting thing, even if you will understand, you need to just learn the rate would be 15 or 20 or other short-term capital gain. So whether it falls under section 111A or if they fall under these transactions, the rated tax is same. Clear? Even if they are long-term, they will transfer over here. Fine. So that was short-term provision we have discussed. If it is 111A, the rate is 15 and 20. If the foreign currency transactions in IFSC, the rate would be same, 15 and 20. If any other short-term capital gain except these two, the rate would be slab rate. So short-term rate provision has been ended. Understand? There are 2 kinds of capital gain, long-term and short-term. Short-term calculation we have seen over here, and short-term rate provision has been ended. So now whatever left is just long-term capital gains, rates, applicability. So at least you should understand now that in case of short-term, either I have to apply 15% or 20% or normal rate of tax. Clear? Moving on to long-term capital gain provision. So in case of long-term capital gain, either it would be a long-term capital gain under section 112A. Remember that section 112A which is having a special cost of acquisition provision. That market value, sale consideration, whichever is lower, then we have to compare it with the actual consideration, actual cost of acquisition, whichever is higher. So that kind of section 112A taxation provision we are discussing. And section 112A, if your gain falls under section 112A, then there is an exemption of 1,25,000. Up to 1,25,000, there is no taxability. Any excess would be taxed as per following provision. Listed equity share, those were over here in a section 111A. If those securities are short term, they are under section 111A. If these are long term, these would be 112A security. You can see same exactly. Listed equity share, STT paid on purchase and transfer both. Then it will fall 112A. Units of equity oriented fund and business trust if STT paid on transfer. So if it happens, if it is before July, rate is 10%. If it is on or after July, the rate is 12.5%. What you have seen over here in short term, transaction in foreign currency, IFSC, and in a recognized stock exchange, the rate was 20 and 15 if they are short term. If they are long term, the rate is 10 and 12.5. So you can see this is exactly similar over here. Even in case of if 111 is short term, the rate is 15.20. If it is 112A, the rate is 10 and 12.5, but there is a special exemption which is not in case of short term. That is 1,25,000. The IFSC concept is same, whether in the short term or long term. The rate is 10 is 12.5. Now, other long-term taxability is quite complicated. Due to that land and building concept, the other long-term capital gain concept is little complex. Let me see if there's any query. In a scheme of amalgamation, Sahil is asking in section 47, what will be the cost at the time of sale, either original cost when we purchase shares or FMV of new share at the time of amalgamation? Purchase price would be your cost, Sahil. STT full form, who is asking STT full form? Nidhi. Security transaction tax, we have gone through with this in under section 112A. Even in PGBP, you must have gone through with STT. Okay. Tanu is asking, sir, जितने से capital gain exceed होगा, वो taxable होगा या फिर whole amount? जितना excess होगा. Suppose हमारा capital gain है 112A में 1,40,000, 1,40,000. 1,25,000 के बाद बैलेंस 15,000 पे सिर्फ टैक्स लगेगा. Don't worry, I'm going to solve these kind of question with you. After this, we will solve question of section 112A. Then this before 23rd of July, after 23rd of July, we will solve all questions. Do not worry. Even if we were not able to solve all the test your knowledge question and etc., then we have class on 5th June. In that class also, we are going to solve multiple questions. That is only a problem class. So we would have a lot of time to solve these kind of practical questions. Just trust me. Remember the provision. I will solve each and every kind of question with you. And after solving, you will find it easy. Like suppose if we did not solve section 54F example, and if I'll ask you to solve yourself, you might feel it is very complicated. What is this ranking? Why is this ranking? How that is investment balance? So if you will try to solve it yourself, that it's going to be very difficult, might be. But when we solve it together, I asked you, you are explaining me that this value should be over here. So that things make it easy. If now you will try that question in the notes of section 54F or in any study material or examination 54F question, you know how to solve it. Okay. So I will help you in each cases. Just do stay with me. Okay. So now this other long-term capital gain under section 112. In case of other long-term capital gain, except this section 112A, now we are having section 112 capital gain. If that is unlisted securities or shares of closely held company. If that is an unlisted security or shares of closely held company. Closely held company means generally private company we are talking. Those are company in which public are not substantially interested. Okay. So if the unlisted security has been transferred or shares of closely held company has been transferred, an assessee is a non-resident, non-corporate, non-resident. Or if assessee is a foreign company, if the transferor is a foreign company or a non-resident, then tax rate is 10% in this situation. No indexation benefit, no TTBR fluctuation benefit. So if that is an unlisted security or shares of private company you are transferring and you are earning any gain, so if you are a non-resident or if you are a foreign company, the rate of tax would be 10%. If you are other than foreign company and non-resident, and an individual HUF, etc., those are resident. And if you are transferring, the rate would be double, 20%, but the indexation benefit would be there. In this case, no indexation, rate is 10. In this case, indexation benefit is there, but 20% rate need to be applied. Okay. Unlisted security, shares of a closely held company. Now, the second point, suppose if this asset is listed securities or zero coupon bond. If the asset you are transferring is listed security or zero coupon bond, so the rate of tax is same for all assets. 10% without index you have to calculate, and 20% with index you need to calculate the tax. Without indexation, calculate the gain and the rate, apply 10%. Also take the benefit of indexation and apply the rate 20%. The lower would be your tax liability in this case. For all assessee, you have to follow. If that is listed security and zero coupon bond. All other asset, like you can say, though does not fall under section 112A. Suppose that is building, jewelry, land, etc., etc., etc. Any other long-term capital gain is there. The rate is specifically 20% with index benefit. So you have to do this much effort to yourself. This chart you have seen, make short notes from this chart also. That in case of short-term cap gain, the rate is 15 and 20. If it is 111A. And if that is International Financial Service Center, then again that is 15 and 20. In case of other short-term, the rate would be as per slab rate. In case of shares under section 112A, the rate would be 1,25,000 exempted, rate would be 10 or 12.5. Same in case of IFSC, 10 and 12.5. Other asset, in that case, if it is a closely held company shares or unlisted security, if it is a foreign company non-resident, 10%, other assessee 20%. If it is listed security or zero coupon bond, then we have to calculate tax twice. Once gain without index and apply the rate 10%. Once indexation apply and the rate is 20%. Lower would be tax liability. And for all other asset except these two, the rate would be 20% with index. You have to learn these provision like this. And if you make short note once yourself, the provision are going to be definitely memorized or stuck into your brain, that we have to solve this question like this. Now the problem is this. If this long-term capital gain on or after 23rd of July 2024 for other assets, those does not fall under section 112A. So now the provision says if it is land and building or both. So before 23rd of July, there are three kinds of capital gain rates we need to learn. A, B, and this C. But on or after 23rd of July, there are just two, A and B. So provision has been less, easier. But this 23rd of July concept, you have to remember in your mind that the question, the first point in solving the question of a capital gain in your examination is to see the date of transfer. The first thing you have to see, the date of transfer is before 23rd of July or after. Because only taking into mind that concept, you have to go further to solve a question. Because that will change everything. The kind of calculation, the way we need to find the capital gain, the rate of tax, the exemption, etc., etc. Okay. So now 23rd of July, land, building or both, if acquired before 23rd of July and transfer on or after 23rd of July. So for the purpose of land and building, there is a benefit. If you are an individual HUF resident, then you have to calculate 12.5% tax without index and 20% with index. For all other assessee, the single is 12.5% without index. So this is simple. Now, land and building or both, if acquired on or after 23rd of July 2024. So if land and building acquired before 23rd of July, if acquired before 23rd July 2024 and transfer on or after 23rd of July, then this benefit. But suppose if land and building has been acquired on or after 23rd of July and transfer after 23rd of July, then the benefit of individual would be gone. The provision would be same for all. So only for land and building, if that has been purchased on or after 23rd of July and transfer on or after 23rd of July, or any other asset except land and building, jewelry, gold, shares, whatever it is, if those has been transferred on or after 23rd of July, the rate would be same for this category, 12.5% without index. In case of non-resident, if the assessee is a non-resident, then in this situation, long-term capital gain on transfer of unlisted security, shares of a closely held company, which was the A case, tax would be 12.5%, index and foreign currency fluctuation. Without index, without foreign currency fluctuation. So this 10% has been increased to 12.5% if the transfer is on or after 23rd of July 24. I do agree with all of you. You all might be thinking, what is this happening? But let me tell you one more thing. This is the most easiest way to make you understand the concept of tax rate in case of long term and short term. Okay, tell me one thing. Is there any problem to understand the long term capital gain rate structure now? I don't think so. It's now easy for you. And is there any problem to understand section 112A provision rate structure now? I don't think so. It is that difficult. Now the remaining thing is just this. So just learn these ABC point again and again. Once or twice, if you learn them, you will understand that again, in which case I have to apply this kind of rate. And let me tell you, when we will read these provision with the notes, definitely you will feel automatically that rate of chart is very simple automatically, because if you will go through the provisions of notes, you will find out it's very complicated. It seems very complicated. Okay. So there are some notes, some clarification for the calculation. Resident individual HUF can claim unexhausted basic exemption limit, the limit of 2.5 lakh, 5 lakh, 3 lakh, that can be claimed from the income those for under section 112, 112A and 111A. And who can claim? Resident individual HUF can only claim. Non-resident cannot claim this 2.5 lakh or 3 lakh exemption from these income. They can claim this exemption from other income. Do not worry, we have question for that. Just remember these provisions that if a resident individual HUF, they can claim their basic exemption limit from these three income. In case of non-resident, they cannot utilize the basic exemption limit from these income. Clear? Bonds and debenture provision we have discussed in section 50AA. Again, repeating over here. Bonds and debenture listed, unlisted. If transfer redeemed matured before 23rd of July, then there would be long term or short term on the basis of period of holding. But indexation not applicable in case of bonds and debenture, except in case of capital index bond, etc. Bonds and debenture listed, unlisted, if transfer redeemed matured on or after 23rd of July, always short term as per section 50AA. No deduction under section 80C to 80U allowed from 112, 112A, 111A. So basic exemption limit cannot be utilized in case of non-resident. In the same way, deduction under section 80C to 80U again not allowed from these three income. Then from which income we can claim? I will tell you. When we will solve example, you will come to understand each and everything. No rebate under section 87A against long-term capital gain 112A. So the rebate we have gone through, that was 12,500 or 25,000 in case of default tax scheme. That you cannot claim from long-term capital gain under section 112. So till here, we have discussed the provision. We have left with point number 7. And these two charts is definitely going to make things so easy for you for calculation of tax. So we will discuss that after the break. So Tanu is asking, what is unexhausted exemption limit? It is different from basic exemption. It is same. Suppose you are having 2.5 lakh rupees exemption limit. Out of that 2.5 lakh rupees, you are having 2 lakh rupees salary income only. Salary income is 2 lakh. So the 2 lakh rupees salary income has been exempted from that basic exemption limit. So now remaining exemption is 50,000. That is called unexhausted exemption limit. How it's going to be utilized against section 112A, 111A and 112, I will explain to you with the help of an example. So first of all, we just need to complete the provision and then we start solving the questions. Okay, students. So Mr. Manish, can we take a short break of 10 minutes? Thank you. Okay, welcome back, everyone. We were discussing the provisions of capital gain rates, and I believe things are very complicated in this, little complex. Let's एक कहानी सुनाता हूँ मैं आप लोगों को छोटी सी, फिर हम कंटिन्यू करेंगे. इसीलिए मैं आज जल्दी चाय पी कर आ गया. ये कहानी सुना देते हैं. तो एक मूर्तिकार था जो मंदिरों की मूर्ति बनाता था. तो एक बार बाजार से दो बड़ी बड़ी रॉक्स लेकर आया मूर्ति बनाने के लिए. पहली मूर्ति को उसने जब अपने हैमर से तोड़ना शुरू करा टू गिव द शेप, तो उस मूर्ति को बहुत दर्द हुआ और वो बहुत पेन में था. तो उसने उसे मना किया कि अरे मुझे मत मारो, मुझे बहुत पेन हो रहा है. उसने कहा अरे तुम भगवान की मूर्ति बनोगे तो सब लोग तुम्हारी पूजा करेंगे, मैं अच्छा फील होगा, मंदिर में रखे जाओगे. तो उसने कहा ठीक है चलो बनते हैं. थोड़ी देर बाद फिर उसने जब ट्राई किया तो उसे फिर बहुत पेन हुआ. उसने कहा नहीं मुझे नहीं बनना, आप मुझे मंदिर के बाहर रख देना, मुझे मूर्ति मत बनो. दूसरी रॉक के पास जब वो गया तो उसने कहा कि मैं तुम्हें बना लूं. तो उस रॉक ने कहा ठीक है कंटिन्यू. तो उस रॉक को भी बहुत पेन हुआ, बट उसने वो सब पेन टॉलरेट किया बिकॉज उसे पता था कि उसे वो मूर्ति बनेगी जो मंदिर में रखी जाएगी. तो जब वो इतने सारी पेन और सफरिंग के बाद जब उस रॉक से मूर्ति बनी तो सब लोग उसकी पूजा करते थे, उसे सुबह से फ्लावर्स मिलते थे, और उसे सब लोग आके ब्लेसिंग मांगते थे. और जो दूसरी थी रॉक जिसने मना किया था, उसको भगवान के मंदिर के बाहर रखा गया था. उस पर सब लोग आकर नारियल फोड़ते थे. तो उसको रोज पेन होता था डेली, पूरी लाइफ लॉन्ग. तो मोरल स्टोरी इज दिस कि लाइफ में एक सर्टेन टाइम पर, सही टाइम पर अगर आप पेन लेते हैं, सेक्रीफाइस करते हैं, सफरिंग को बेयर कर लेते हैं फॉर द एम ऑफ योर लाइफ, तो फ्यूचर में आपकी लाइफ इजी हो जाएगी. और अगर अभी आप ये सोचते हैं कि मेरी लाइफ टफ हो जाएगी, मैं पढ़ूंगा क्यों, मुझे अभी नहीं पढ़ना, पढ़ना पसंद नहीं है, और बोर लगता है या आपको बहुत दुख होता है पढ़ने में, तो फिर बाकी का फ्यूचर बहुत डिफिकल्ट हो जाए. तो थोड़े टाइम की सफरिंग, थोड़े टाइम का हार्ड वर्क, थोड़े टाइम की मेहनत, पूरे टाइम की अपनी चीजों को, पार्टीज को, घूमने फिरने को छोड़ना, पूरी लाइफ आप लोगों की बहुत अच्छी हो जाएगी अगर ये आप अभी इतना सेक्रीफाइस या पेन लेने को तैयार है. दूसरा ऑप्शन में अभी लाइफ हो सकता है आपकी इंटरेस्टिंग हो, आपके दोस्तों के साथ आप घूमे फिरे, टाइम वेस्ट करें, but future would be really hard for you. So either give your 5 years to your study, 4 years, 5 years, and live the life you always dreamed of. Either it would be vice versa. Enjoy these 3 or 4 or 5 years, and then you might have the nightmare you have never dreamed of. So that was the story for all of you students. Let's go ahead. Okay, so Ishan is saying, sir, in section 46 say buyback before 1/10/94, 23.29 for the companies under capital gain. No, it's a kind of a distribution tax that company needs to pay. And even at your level, intermediate level, there is no calculation of GTI of companies in its syllabus. So even if the question has been framed, they will ask you what is going to be the tax liability in case of buyback of shares. So we just need to calculate the tax at the rate of 23.296%. Priyansh is saying, my brother tells same 5 years of struggle, 50 years of happiness and easy, and vice versa. Absolutely correct. He must be a wise man. Okay, Kevin is asking, sir, in the chart PDF, I could not find the chart of cost of acquisition in case of non-depreciable asset, like goodwill, equity shares, bonus, and right. I have uploaded two charts, Kevin. The second chart I have uploaded for rates of tax, but the initial chart what I was uploaded was regarding the cost of acquisition. Try to download it and it would be there. Okay. Yes, all for your motivation, of course. We, the Board of Studies, the coordinators, technician, ICAI, all are just doing each and everything for your benefit, and you have to take the benefit. Okay. Chalo. Moving on to the rate of tax provision. So now after point number 6, now point number 7 is for those TTBR, TTSR provision, and you can see the point number 7 says that long-term capital gain on listed shares other than 112A or debentures of an Indian company acquired in foreign currency for non-resident calculation as under if it is before 23rd of July, then 20% tax without index, but with the TTVR and TTSR provision. On or after, the rate would be 12.5% without index, but TTVR and TTSR provision. Now moving on to understand how we need to calculate the gain practically. So let me tell you, the chart is there, but I want to prepare this chart again on this whiteboard or yellow board. So you would be understand it more clearly. So suppose if the question asked is before 23rd July 2024, and if it is for resident, if the question is for resident assessment. So do one thing, always divide the GTI. You must have given the GTI in the question, or you might have calculated it yourself. So whatever is your gross total income, you have to divide that gross total income into this 5 category of income to calculate the tax. So for the purpose of calculation of tax, you have to divide your gross total income in these 5 category. Here is casual income that we are going to discuss in income from other source. But for the time being, let me tell you, casual income means winning from lottery, etc. Games, these are called casual income. And the rate of tax is 30%, and that is fixed. What is the meaning of fixed? I will explain it later after completing this chart. So that is fixed. Casual incomes, if there is casual income in this GTI, like winning from lottery, game show, etc., that part need to be written down over here. Clear? Then long-term capital gain under section 112A. We have gone through with the rate of structure of this. So there would be 10% because this is before 23rd of July 2024 we are discussing. The rate would be 10% taxability, and there would not be any rebate. The rebate of 50,000 under optional tax regime and 12,500 under optional tax regime and 25,000 under default tax regime, that is not applicable in case of this long-term capital gain under section 112. And you can see I did not write fixed over here. Like I have written it in case of casual income, I did not write it over here. There is a reason behind it. We will explain it. Then if short-term capital gain under section 111A is there. What would be the rate before 23rd of July? It was 15%. Clear? Then long-term capital gain, other long-term capital gain, and they would be of 2 kinds of other long-term capital gain, that there could be listed security or zero coupon bond. We have seen that via chart. 10% tax without index and 20% tax with index. Whichever is lower need to be included for the tax liability. Other long-term capital gain except these is going to be charged at 20% with index. Clear? And the remaining would be called other incomes. So if I'll ask you what would be included in other incomes, what incomes is going to be included in other incomes? Tell me. So other incomes category, what income is going to be included? Somebody answered. PGBP, house property, salary. Very good, correct. So that would be PGBP, house property, salary, other short-term capital gain. Remember, other short-term capital gain, we said that it would be taxed as per slab rate or normal rate of tax. So other than 111A, the short-term gain would be also included in this other category of income. Income from other source except casual income, like interest, dividend, etc. So income from other source except casual, because casual income is having separate rate of taxability. So that would form part of my other income. Clear? You can easily see that we did not use that symbol of F. F means fixed in these 4 categories of income. Now let me tell you, whatever is the total of this income, now we need to reduce deductions under section 80C to 80U. Remember the notes, the clarification we have just seen over here. Point number 5, that no deduction from 80C to 80U allowed from 112, 112A and 111A. So if you will follow this diagram to calculate the rate of taxes, to calculate the tax, you would automatically follow that clarification what I have mentioned over here, because deduction can be only reduced from these category of income. So because deduction benefit we have to reduce from here, so it cannot be available from 112 or 111A or 112A. So always follow this format for calculation of tax. The question we are going to practice, I will solve all those questions in this format. So now with remaining this value, this is your taxable other income. So we are having this casual income, one income block representing the income. This block is also representing income. This block is also representing income. And this is also. So the total of all these 5 blocks, if I'll give them the name, this is 5, this is 4, this is 3, this is 2, this is 1. So total of 1 to these 5 blocks would be called total income. So this was taxable income of this part. So total income would be all these 1 to 5 boxes. Why I'm asking you to calculate the total income also? Why do we need that? Because to find out the rebate concept, whether rebate need to be applied, whether surcharge need to be applied. For the purpose of rebate and surcharge, we have to see the total income. So always calculate the total income after finding out these 5 blocks, because accordingly now we can see whether rebate is available or rebate is not available. Clear? Now the concept of basic exemption limit was there. Remember, we have seen this 2 clarification. Point number 1, basic exemption limit, and point number 2, basic exemption limit. Let me explain you what is the concept of that. So because in case of resident, the case we have taken for resident, the basic exemption limit is if we are going through default tax regime. The basic exemption limit is 3 lakh. Clear? So first of all, I have given the number 1 to this block, 2 to this, 3 to this, 4 to this, 5 to this. We have made a systematic chart. The basic exemption limit first benefit needs to be given to this income, 1 category. Suppose this total income is my 2 lakh rupees. And my basic exemption limit is 3 lakh. So out of my 3 lakh, first of all, you have to give the benefit to this other category of taxable income. So 2 lakh would be utilized out of the basic exemption limit from other income. So that income is now nil. The remaining 1 lakh is called unexhausted exemption limit. The word somebody was asking me what is the meaning of unexhausted exemption limit. The remaining after setting off the basic exemption limit from the first category of other income, the remaining is called unexhausted exemption limit. Now this 1 lakh can be utilized from this income. Suppose this income comes to 30,000. So I can utilize 30,000 from here. Clear? The remaining is 70,000 unexhausted exemption limit. This can transfer to this, and if there is any remaining, that could be transferred to this. But remaining cannot be transferred to this because that is called fixed. So when I write it down fixed, fixed means that is going to be taxed fixed. basic exemption limit cannot be utilized where I have written fixed concept. So we can utilize it first from other income, then we can utilize under section 112 gain, then 111A gain, and then 112 gain. Still, if there is any unexhausted basic exemption limit remaining, it cannot be transferred from casual income. Casual income is going to be taxed fixed. The balance exhausted limit is useless, it's waste. So for the purpose of examination also, you have to use the basic exemption limit in this systematic format. Clear? So that was the chart I have prepared for you. This one. Tax calculation, gross total income need to divide as follows. You can see casual income 30% fixed. This is 112A, then 15, then other, then deduction, then slab rate provisions are there. Now, if it belongs to non-resident, if this is the case for non-resident, then for non-resident, there could not be any rebate, not from any income. In case of resident, rebate is not from 112A. But in case of non-resident, there is no rebate at all. Again, we will divide that in 5 categories, and now you will see casual is fixed. 112A is also fixed in case of non-resident. That means the basic exemption limit, unexhausted limit, cannot be utilized from 112A if the assessee is a non-resident. Even 111A is fixed now. You cannot utilize it against 111A also. Then we are having other long term, and then we are having deduction. Again, the same concept, unlisted would be taxable at 10% without indexation benefit. Zero coupon bond, etc. is 10 or 20. All other is like 20%, and balance long term is 20%. For the purpose of examination, I believe the other long term would be only in the question. And there could be listed security or zero coupon bonds. These would not be there in my opinion, but if it is there, you have to remember the provisions. So now you can see these two notes, what we have discussed earlier has been explained to you. Non-resident cannot claim the unexhausted exemption limit from 111A, from 112A, and from 112 also. This is also fixed, students. Okay, this is also fixed. So only the non-resident can claim the basic exemption limit from this other category of income. So that was the provision before 23rd of July 2024. Almost same provision is for category. The diagram we have explained. You can see resident can claim basic exemption 2.5, 3 and 5 from other income, then from long term, then from short term, then from 112A only. Also refer to 15 BAC exemption and rates. While non-resident can claim exemption of 2.55 and from other income only, refer 115 BAC exemption limit. Tax need to calculate in most beneficial manner. The chart is for on or after 23rd of July. So there is no change, only the rate is now 12.5% in case of long term, and in case of 111A, it's 20%. All other concept is same. You can see 30% fixed, 12.5%, 20%. So the rate is just changed 20 and 12.5. 12.5. Slab rate, same provision, there is no change. Again, if non-resident, the thing is you cannot claim the basic exemption limit from these category of income also. So in case of non-resident and resident, only one change is there. You cannot claim the rebate and you cannot claim the basic exemption limit from any income except that first category of other income. Clear? So please go through with this chart also, and you will be able to understand the chart when we will solve question one by one. So that was the provision. Let me now show you. Krishan is saying, sir, in long-term cap gain, you have written that no rebate, but it is added in total income. Then the rebate is calculated. Why it is so? The rebate is from taxation. For the purpose of calculation of total income, long-term cap gain 112 is going to be included. So if it exceeds 5 lakh or 7 lakh, then there would be no rebate for anyone. But if that is less than 5 lakh or 7 lakh, even if there is rebate, we cannot give it that rebate to the long-term capital gain 112A. But for the purpose of TI, we have to include it. So now let me show you how chart is simple, and you will come to understand that when you will see the provisions. So all those provisions we have discussed in chart presentation is now as per theoretical concept. You can see first the concept is explaining how to calculate short-term capital gain provision. And you have seen that we have gone through with that concept of short-term cap gain, how to calculate without cost of acquisition, without cost of index cost of acquisition. Now this is long-term cap gain, and that is before 23rd of July with indexation benefit. That also has been discussed in the chart. Then in case of long-term cap gain on or after. So there would not be any indexation concept, only cost of acquisition and cost of improvement need to be reduced. Now rate of tax you can see, if that is 111A, the rate we have said 15% and 20%. In case of foreign currency, recognized stock exchange, and if it is an international financial service center, the rate would be 15% or 20%. Before July 15, after July 20%. We have gone through with the provision. Other short-term capital gain rate would be normal rate of tax. I hope it's clear. Now long-term cap gain tax structure. If it is 112A, 1,25,000 exempt, the excess would be taxable at the rate of 10% if it is before, 12.5% if it is after. What kind of share does fall in this category? It is explained. Equity shares on which STT has been paid, etc. If that has been done again from recognized stock exchange, international financial service center, in foreign currency, the rate would be again 10 and 12.5%. Indexation benefit and PTBR benefit not available. Now other long-term capital asset other than 112A, normal 112. If transfer before, then you must have remembered that unlisted security and shares of private company closely held. If you are a non-corporate, non-resident or a foreign company, rate is 10, otherwise rate is 20. Listed security and zero coupon bonds, rate is 10 or 20. Without indexation, with indexation, whichever is more beneficial. That means whichever is lower. Other asset, 20% with indexation money. Now, on or after 23rd of July, if that is immovable property which has been acquired before 23rd of July, if you are individual HUF, resident, 12.5% without benefit, 20% with benefit. For all other assessees, 12.5%. Asset other than this, that means land and building or both, if acquired on or after 23rd of July, or any other asset which has been transferred on or after 23rd of July. The rate is 12.5%, except in case of non-resident, long-term of unlisted share that would have been taxed earlier 10%. Now it is going to be taxed at 12.5%. All notes are those which I have written in the note sheet. You can go through with that. That the basic exemption limit you can utilize from 112A, 112 and 111A in case of a resident. If you're a non-resident, you can only utilize that basic exemption limit from your first category of other income. Clear? In respects of bonds and debenture, if it is before 23rd of July, you have to find out the nature of gain. On or after 23rd of July, section 50AA there. So it's always short-term capital gain. No reduction under chapter 6A. 6A means section 80C to 80U deduction. You cannot claim these reduction out of these income, whether you are a resident or a non-resident, whether that is before 23rd of July or after. Rebate 87A not available in case of section 112A. In case of assessee pays tax under default tax regime, the surcharge provisions is there. So surcharge concept you can go through with basic concept chapter 1. We have already seen the surcharge applicability in these cases. Again, the period of holding provision, it has been repetitive. We have already gone through with when asset would be short term, when asset should be long term, before 23rd of July, after 23rd of July. So I have copied that provision from there. So just you can recall over here also that what kind of asset is treated as long-term and what is short-term now. Now those provision what we have just gone through, now they are in detail. So you can go through with this provision detail if you want. Otherwise, the same provision has been copied. There is nothing new in this concept. I just want to solve questions with you right now, so you would be able to understand that how do we need to solve the question in the examination. So we'll start with this illustration. Illustration number 13 we are going to solve. So that will make you understand how to solve a question. Okay. So if there's any query, let me see. Cap gain is 550 and remaining income is less than 5 lakhs. So rebate would not be available to anyone, Ishan, because if your long-term cap gain, we are talking about optional tax regime. So up to 5 lakh, if your TI is 5 lakh, you can claim the rebate. So whether it's, even if your TI exceed 5 lakh, including that long-term, there cannot be any rebate. Now let's solve this question one by one. I have the question also separately. Okay. So the calculate the tax liability in the following cases. The first cases, they are all separate 4 cases. It says, suppose Mr. A, age 45, non-resident. So it's very important to know whether the person is a resident or non-resident. We have to calculate the tax as per both regime, under default tax regime and as well as under optional tax, both cases. Okay. So total income other than long-term capital gain, other than long-term other income has been given 2,40,000, and long-term capital gain, assume transfer took place before 23rd of July, 85,000 from sale of vacant site. Now tell me one thing, first of all, under default tax regime, what is the basic exemption limit in case of non-resident? And second, can a non-resident claim rebate? The basic exemption limit in case of default tax regime is 3 lakh. Absolutely correct, Ishan. Very well done. And there is no rebate. Now, if I'll ask you to solve this question, as I have prepared this chart. So what we need to do, we just need to do this thing. Non-resident, no rebate. So I have asked you to prepare always these 5 parts of income. So there is no casual income in this case. There are only 2 income, total income other than long-term cap gain. So this income has been given in the question. It's 2,40,000. And the long-term capital gain, because section 112A has not been given. 111A has not been given in the question. So this would be treated as long-term capital gain, 85,000 from sale of vacant land. Clear? Now, the basic exemption limit for a non-resident is 3 lakh. Out of this 3 lakh, 240 is going to be utilized over here. So if 240 has been utilized, so we will call unexhausted exemption limit is 60,000. Now, as we have gone through with the provision just few minutes before, whether this unexhausted exemption limit is allowed to section 112 or not. Not allowed. Very well done, Ishan. This is not allowed. So we have to tax that long-term capital gain at the rate of 20% because this is a case of before 23rd of July 2020. So tax would be 17,000. Straightforward. Clear? Rebate cannot be applicable. Even your total income is less than 7 lakh under default tax regime, but because non-resident cannot claim the rebate. So rebate is not applicable. Surcharge is not applicable because income is less than 50 lakh. I have asked you in the basic concept topic. Always follow this format. Tax, rebate, surcharge. Write it down, rebate. And you can write it down, not applicable in the front. But please make a habit that you have to write it down, rebate and surcharge. Then we have 4% cess. And that would be 680. So my tax liability would be 17680. Clear, students? Now question number 2. Mr. B, age 62 year, non-resident. So again, basic exemption limit would be 3 lakh. And rebate would not be allowed. And now the question says 10,000 from sale of listed equity shares, STT paid on sale and purchase of shares. So STT paid on sale and purchase of shares from listed equity shares. So that means long-term asset. So it is section 112A case. Because we are having long-term listed equity shares, STT paid on sale and purchase on both. So in that case, up to 1,25,000 is exempted. And here is only 10,000. So full value is exempted. We are only having one income, that is 3,10,000. Up to this 3,10,000, 10,000 is going to be taxed at the rate of 5%. So tax would be 500 rupees. No rebate, no surcharge. 4% cess would be 20 rupees. Total tax would be 520 rupees. Clear? Third case, now you have to see it is a resident, 81 year of age. What is the basic exemption limit for a resident if it is age is 80 year or more? Or rebate can be claimed or not? Please answer these two questions. Ishan is saying 3 lakh and rebate. Ishan, please read the question. 5 lakh rupees exemption in case of a resident if it is 80 or more. And if you are a super senior citizen, if the exemption is 5 lakh, then what would be the case? The case would be if it is 5 lakh exemption, that would be only in case of if we are solving that question as per optional tax regime. So when we notice the age and the status, we generally apply 5 lakh rupees benefit provision. But remember, we are solving the case as per default tax regime. In that case, the basic exemption limit will remain 3 lakh, irrespective of the age. So in that case, you can see the 60,000 gain is from sale of agricultural land in rural area, which is not an asset. So again, this is non-taxable. Only we have 5,90,000 remaining. Out of this 5,90,000, you can see 3 lakh would be the basic exemption because we are solving it as per default tax regime. 1,90,000, sorry, 2,90,000 would be our income. And on 290, the tax would be 14,500 rupees. But there is a good thing. The TI is less than 7 lakh rupees. And you can claim a rebate of 25,000 rupees in case of category C in this example. So the rebate would be 14,500 and tax liability would be nil in this case. Understand? So here's a solution also. You can see first case 17,000, 680, 500, 520. Third case 590. The tax would be 5%. It's 14,500. Rebate is up to 25,000 or amount of tax, whichever is lower. So tax liability would be nil. So on, try to solve case number D also, and try to solve these example under default tax regime also. Clear? The solution is here. It's kind of a homework for you. And we can discuss if there is any problem on our problem class. That would be on 5th of June. We are going to solve more questions. And this is, please understand and please follow this. Revise my advice. Please revise twice everything. So let's move on to some other question. First of all, we are going to discuss question number 12 and 13 of homework, which I have given to you in the last class. So question number 12 and 13, we want to solve. So you must have remembered, I believe, this question. So question number 12, a domestic company issued 25,000 share at a price of 30 rupees per share. Face value is 10 rupees on 8th April 2015. Subsequently, in April 2024, the company bought back 10,000 shares out of them from a shareholder at a price of 50 rupees per share. Explain the treatment in the hands of a company as well as shareholder. So what is going to be the treatment in the hands of a company and the shareholder? And as this question belongs to buyback of shares, so date is very crucial. This is before 1st October. So that means old provision would be applicable. So let me see what is the answer given by you. Ishan is saying in case of company, they have to pay rupees 116480, and for shareholder, it is exempt. In the case of shareholder, it is exempt under section 1034A because up to September 30, there is no treatment in the hands of the shareholder. In the hands of the company needs to pay tax. So that would be called buyback distribution tax. Under section 115 QA at the rate of 23.296% of the excess value paid. So now excess value, 10,000 shares has been bought back and company has paid excess value of 20 rupees because 30 rupees was the issue price and bought back at 50 rupees. So this is the 20 rupees which is going to be taxed at the rate of 23.296%. So this additional tax would be 47,920 rupees. In the hands of shareholder, that is going to be exempted. So on the difference of value, the amount of buyback companies paying, so the excess they are paying, that is going to be calculated for the purpose of section 115 QA. The next is question number 13. Now the question says, date is very crucial, students. The question says, a domestic company issued 10,000 shares at a price of 30 rupees per share, face value 10 rupees on 8th April 15. In December 24, that means new provision would be there. When there is new provision, in case of company, there is not going to be taxable anything. No treatment, technically we can say not applicable. But now in case of shareholder, there are treatment under two heads of income. One is income from other source, deemed dividend, and one is under capital gain. So what is going to be the answer of in the hands of shareholder in this scenario? Tax 75,000 income from other source. I am not asking for tax in this case. I am just asking about the income need to be treated. Ishan is saying correct. The income would be 6 lakh. as the deemed dividend, and the capital gain sale consideration would be nil, and whatever he has paid 30 rupees per share at the 10,000 share, that would be his capital loss. Well done. There are few more questions I am going to discuss with you one by one. So this is question number 1. Send me your answer. Exemption under section 54F is available to 54F exemption is available to which SSC? Ishan, the gain amount, the company has purchased those shares. Let me show you again. In question number 12, the company issues those shares at 30 rupees per share. Clear? And bought back at 50 rupees per share. So the difference is going to be taxed as buyback distribution tax. Okay. So 10,000 into 20, and upon that we apply the rate of 23.296%. So the answer was individual, and HUF is the correct answer, of course. The correct answer is section 54F, that is option number C. The second is the exemption under section 54F is available to the extent of capital gain invested in the residential house property, proportionate to the net consideration price invested, to the extent of amount actually invested, or to the maximum extent of 50 lakh rupees, which is the correct answer out of these. Ishan is saying B, Pooja is saying B, Soumya is saying B. Absolutely correct. The correct answer is B. Total income for the assessment year 25-26 of a non-resident individual, including long-term capital gain of building, that is before 23rd of July 2024, is 3 lakh rupees. After including this 90,000, the income is 3 lakh rupees. The tax on total income shall be apply optional tax regime. You have to calculate optional tax regime tax. So let me help you, students. Make this 5 part of the income. Is there casual income in the question? No. And the question relates to non-resident. That is before 23rd of July 2024. You have a long-term capital gain on building. That means 112A, not applicable. 111A, not applicable. You are having 90,000 building value and 3 lakh rupees, this value. Now the total income after including is this. So that means this is 2 lakh 1,000, the balance value. Because 3 lakh includes 90,000. So the balance income is 21,000, 2 lakh 10,000. Now the basic exemption limit in this case, in case of optional tax regime, would be 2 lakh 50,000. So 2 lakh 1,000, 10,000 would be used. Unexhausted basic exemption limit we cannot use in case of non-resident. So this is going to be taxed at the rate of 20%, 18,000. We cannot use the rebate even our total income is less than 5 lakh, but because it's non-resident, no rebate, no surcharge. Cess would be applicable, and that would be 720. The correct answer would be 18,720. Harshada, don't give your answer in hurry, and Soumya also, because you have to calculate tax by applying cess also. Even the examination, if you see the figure 18,000 and you're going to tick it, that would be a wrong answer. Okay. So take your time and solve the question properly. Next is question number 4. Total income of a resident individual aged 58 years, including long-term capital gain of building. Now it is a resident individual. Age 58 years, including long-term cap gain of building 40,000, is 2,60,000. So that means in this 5 category of income, we are having 40,000 and 2,20,000. And you are a resident also. So 58 here. So we are having limit of 250. Out of that 250, 220 is going to be utilized. Now, because you are a resident, so now you can utilize the exhausted limit out of your long-term capital gain. So the income would be 10,000 and the tax would be at the rate of 20% you have to charge on long-term capital gain. So my tax is 2,000. So what is the correct answer? After this tax of 2,000, what is the next step we have to calculate? Ishan is saying 2080. Okay. Anyone else? Tanu is saying nil. Okay. Why nil, Tanu? Why it is nil? Kirti is saying 2080. Correct. Ishan, you have done mistake. I have told you multiple times, students, multiple times. It's resident individual. Whenever there is tax, kindly follow this rule. Rebate, surcharge, cess. In this case, rebate is applicable up to 12,500 rupees. Rebate is there because my income is just 2,60,000. It's a case of resident. So he can claim rebate of 2,000 and the answer is nil tax. Option B. Okay. Please follow the format. If this kind of silly mistake you will do in examination, that in the examination you forgot about the rebate or surcharge or cess, you will definitely regret once you will come home and you will check it out what kind of mistake I have done. Look, our situation in examination is this, that you do not know the answer or you do not know the provision. That's why you are not able to solve a question. So that kind of question does not hurt you that much. But when there is a question which you know completely, and if you do this kind of silly mistake, that kind of mistake really hurt a lot. It's going to hurt you up badly. Because so please avoid these kind of mistake. This is the difference between a pass and failure of a basic student. That if you do not do mistakes on those questions, you know how to solve it. So definitely you are going to clear your group. Okay. Next is point number 5, long-term capital gain. The correct option, I guess it's B. Then I just want to solve more question of numerical with you. Now this is question number 7. Where is 6? So the 6 correct answer was B, and now it's question number 7. Question number 7 again regarding the capital gain. Ram acquired land from Ravan on 15th December 2008 for rupees 8 lakh, which was sold on 15/5/2024 for rupees 21,50,000. Expense on transfer was 20,000. He invests rupees 3 lakh in the bonds of Rural Electrification Corporation Limited on 16/12/2024. Compute the capital gain. So in this case, the sale consideration is 21,50,000. Can you tell me which exemption is applicable in this example, or which could be applicable actually? Then expense on transfer was 20,000. So the net sale consideration is 21,30,000. Index cost of acquisition as the transfer has been done earlier. It's 8 lakh into 363 upon 137. So it would be 2,119,708. The gain would be 10292. So can we claim exemption of section 54 EC in this case or not? Now we have to reduce the exemption. 54 EC. He invests 3 lakh rupees. So can we claim this exemption over here or not? As per the provision of section 54 EC, can we claim this exemption or not? Are the conditions to claim this exemption has been satisfied? I am waiting for your answer, students. Can we claim this exemption or not? No, because it is not an depreciable asset. So where is the condition in section 54 EC that it should be a depreciable asset? The section says it should be an immobile long-term capital asset and you have to purchase some specific bonds. Sahil is saying, yes, we can claim the exemption, sir. Correct. Priyanshi is correct. We cannot claim the exemption because the time period to claim exemption under section 54 EC is 6 months from the date of transfer. 6 months from the date of transfer. So it has been transferred on 15th May. June, July, August, September, October, November. So till November 14th, 2024, we have to invest in these security. And because 6 months have been passed on, we cannot claim this exemption. The correct answer would be option number A. Next is question number 8. The provision says, Ram purchased a plot of land in Agra for 15 lakh on 5 July 2024. The land was sold on 5th June 2024 for 75 lakh. Compute the cap gain on sale of the land if he invested rupees 25 lakh to purchase new agricultural land in rural area before due date of ROI. Now this is a very, very interesting question. Let me tell you how. The sale consideration is 75 lakh. Clear? Now, if you calculate the index cost of acquisition, that would come 15 lakh into 363 upon 113. That would be 4818584. So resultant capital gain would be 2681416. Now we have to see which exemption is applicable in this case. Which exemption is applying in this case, students? Is there any exemption we can claim? I believe somebody will give the correct answer. $1,25,000, Tanu. Why? We did not transfer shares. Priyanshi is saying 54B. Correct. Transfer of land and to purchase another agricultural land, whether in urban area or in rural area. Clear? So section 54B exemption would be there for 25 lakh rupees. After that, remaining gain would be option B is the correct answer. Now let me extend this question for you. A very interesting question now I'm asking to all of you. Listen carefully. As per section 54B, the new asset should not be transferred within 3 years from the date of purchase. So we have purchased this asset before due date of ROI. Clear? Now suppose if I extend this question and I say this new asset has been transferred for 40 lakh rupees next year. Calculate capital gain. Can you tell me how much capital gain would be there in this scenario? If this new asset has been transferred, sold for 40 lakh rupees in next year, so how much capital gain would be there in the next year? Take your time and think about it. Ishan is saying 40 lakh. When I say it's a very interesting question, and if I say take your time, think about it. Do you really think, Mr. Ishan, that it would be that simple? So I am applying my 2 or 3 minutes to ask this kind of simple question. No, there must be something else in this question. Read the question properly. Don't be in a hurry. Take your time. Then make decision. Then give your answer. Your answer is wrong. Okay. So you have to think about it. It's not that easy. So anybody else? Sunil Kumar is saying 4,25,000. How it came? I don't know what calculation. 42,50,000. How it's possible? Priyanshi is saying 37,50,000. What are you doing, guys? Read the question properly. Read the question. The answer is in the question. Ishan is saying now nil. Now 40 lakh gain come to Harshada is saying cannot sell. Array, we have sold it. Nobody can stop us. We can sell it. And the next day we can sell it. But capital gain can be taxable only. This is the consequence. Nobody can stop you to sell those assets. So, anyone else? Why Ishan is saying no? Nil? Oh, very interesting. The asset we are transferring, this asset we are transferring. And what was this asset? This asset was agricultural land in rural area. So we have violated the provision. The provision was saying you cannot transfer it within 3 years. And we transferred it. But you didn't get it. What we transferred? We transferred agricultural land in rural area. And that is not a capital asset. As per the definition of capital asset, agricultural land in rural area is not a capital asset. So even you will violate the provision. There would not be any capital gain upon you because department cannot calculate capital gain in this case. They can reduce your cost of acquisition with the amount of exemption as we do in normal case. They can do when there is chargeability of capital gain apply. But when the asset you are transferring is not a capital asset, so how they will charge it? And if they cannot charge it, how they will reduce the cost amount or the exemption amount? So it's a very, very smart tax planning. If you want to transfer your agricultural land in urban area and wants to purchase something, then purchase the agricultural land in rural area. And even on the next date, after claiming exemption, you can claim the exemption. Even after next date, if you transfer that agricultural land in rural area, then your exemption would be still there. Nobody will take your exemption. And you need not to pay any gain on transfer of agricultural land in rural area. You can see the tax planning. So when you understand this income tax, you know how to plan your taxes. Okay, so that is a very interesting tax planning tip I have given to you. Okay. So fine. So that was question number 8. Moving on, next question. Now, Mr. X has sold his land for a consideration of 25 lakh to Mr. Y. This is for calculation of section 50C, stamp duty value sale consideration. So the correct answer is option number B. Okay. This is on reverse mortgage scheme. We all know But any amount received on reverse mortgage scheme, whether monthly, etc., cannot be treated as your income. These 11, 12, 13 we have already discussed. Student, you can ask your queries. Ishan sir, if long-term cap gain 112A and other income is less than 5 lakh in optional regime, then also rebate not allowed or allowed. Rebate is allowed only on the tax we have calculated on other income. Whatever tax we will calculate on section 112A income, we cannot claim rebate out of that income. We have some that kind of question also. We will cover those questions. Test your knowledge question. We are having 7 test your knowledge questions. We will cover all of them and some also other questions on 5th of June. Till that, you can revise all these provision as well as the income from other source classes, what we are going to take in our next 2 sessions. Okay, Goldie Anil. Okay. Students, any more queries? Because if I'll take test your knowledge question, it will take at least 15 minutes for a single question. So I guess we do not have that time. So you can ask your queries. Let me tell you, the chart we have discussed today for rate of taxes. I believe it is not simple, it's complex. But tell me one thing, as we have solved some question of tax rates now, do you really think that chart or that rate of tax provisions are now feeling that complicated, that scary? Even when we just solved 2 or 3 examples, when I will solve with you more questions of test your knowledge, you will feel that chart really makes provisions very simple. Because if you following that chart, so deductions we have to claim from other income. So that mistake automatically we overruled. You will give the basic exemption limit one by one. So that basic exemption limit problem will be solved. We have to calculate the total income. So we will find out whether rebate is need to be given or not. And the very interesting thing, even if you calculate tax wrongly of any one income, suppose you calculate tax wrong on 112A income, then at least in examination you can have the step marking benefit if you are going to calculate tax of other incomes correctly. Suppose if you are going to calculate tax not with chart presentation, but as a whole, then if aggregate amount of tax, any tax rate has been wrongly applied by you, then the whole calculation would be waste for us. So please try to solve question also with the help of that chart. So you would be able to understand how to apply deduction, basic exemption limit, rebates, surcharge. These are very tiny things, but yet very important to solve any questions. So if you practice, definitely you will be able to understand the chart and the rate of tax provision also. And I am making you this thing very clear when we will solve test your knowledge question. And I have prepared some more interesting question for you. So on 5th of June, when we will take all these things together, you will find it out. Capital gain is easy. One request from my side to all of you, please revise capital gain full chapter before 5th of June. Please revise the whole chapter. So you will be able to connect the provision. If I'm doing indexation, if I'm applying the rate of tax, if I'm applying the cost of acquisition special provision under section 112A. So if you'll revise and then you will come into the class of 5th of June, you will find it out that capital gain was an easy topic. And the good news, the next topic is income from other source. And I believe that is easiest from this all comparative to all other 4 heads of income. There's one amendment in income from other source provision regarding some insurance maturity proceeds, section 10, 10D, etc. That actually make it little complicated, but in comparison to capital gain, PGBP, house property and salary, it's still easy. So we will complete that income from other source in our next session. That would be on 29, and the next session after that would be on 3rd of June. So 2 sessions for income from other source. Then we are having our problem session, and after that we will move on to clubbing provisions, set of provision, etc. My request to all of you, please revise your capital gain properly. Even you can try that test knowledge some of those questions yourself also. So that is your homework. Try those questions yourself. So when I will try to solve those questions for you, so that is going to be very easy for you to understand what we are talking about. Okay. So if there is any query, student, you can ask. There would not be any recap of the provision in case of income from other source topic. So do not prepare for any summary provisions of capital gain, etc. in our next session. So if there is no more queries, we can close the session, students. Manish sir, I guess there is no more query at my part, so we can close.